All right, everybody, thanks so much. Good Data, thanks so much for lunch and sponsoring the lunch. And as we get going, we've seen definitely some differences between, obviously, the RA channel and how they run their businesses, how they run their investment committees, how they evaluate investment strategies. And then we saw even further when you get into larger firms, consulting firms. So we had a good mix up there between large and small consulting firms. They're definitely a little bit different, and their business model has a little bit different constraints placed upon it relative to RAs. And now we have the bank and insurance channel. And I think you're even going to find much greater differences because of how they're creating product, whether it's sub-advise, UMA, their audience. And so I thought it'd be very illustrative to have, to hear their comments, and it will end up being quite different than what you heard from the RA and the consultant. So I'll turn it over to Dan DiDomenico, our president, to introduce the panel. Thank you.
Fantastic. Thanks, Guy. And let me add myself here to the long line of folks that have been thanking you all for attending and making your way here to the Dakota Insights Conference. Thank you and welcome. As Guy had pointed out, there are a lot of key differences. I would call it diversity in terms of the assets and the purview that our panel here has oversight over. I'd also say and add myself, I love Jerry McDonald's opening remarks and questions about a standing ovation after a meeting. I have yet to receive one of those, but I also say I've yet to be booed as well in a meeting, which I'm hoping to keep that track record intact here today. But my point to saying that, my point to bringing all that up is it's so rare that we get this type of an opportunity to sit in front of allocators, research folks that can bring to us insights and truly give us guidance and advice around our approach, how they like to be approached, and ultimately how we can work best and interact with them and their teams. So let's get to our panelists here. Thank you for joining and taking time out of your busy days and your busy calendars. To my left, we have Eric Lee with US Bank. We have Rick Iwanski with Northwestern Mutual. Nadia Papagiannis with, Nadia is, I would consider her to be our alternatives expert here on the panel from her days at Morningstar and Goldman Sachs. We have Tom Pierce with Wilmington Trust, and from United Missouri Bank, Spencer Byrne. Thank you all for joining. So I thought we'd just jump right in and start at the top, right? I'd ask you to think about, and this is a very important topic in terms of our audience, especially when you think about sourcing new managers, sourcing new investment strategies. I'd ask you to think about it from the perspective, not only from the quantitative upfront screening mechanisms that maybe you use, but also from a qualitative perspective. If there are networks in terms of folks that you see, many here in the audience, and relationships that you have, where you rely on them to bring new investment ideas. So Eric, why don't I start with you to bring some perspective to that question?
Sure. I think obviously, using the data, like things like Morningstar, are a lot of times where we start. But the insight from, say, the relationship folks that we interact with can be helpful, because a lot of times I think we all know there's failings or areas where, say, the peer groupings in Morningstar or even in Lipper data isn't exact, or it's very broad. And if you can bring us a little bit of insight that maybe we can't see from the data about what's unique about that team, or especially their process, is very helpful. And a lot of times I think we figured that out as we thought we understood a strategy. And then from meeting with someone from the team and kind of hearing a more full story, it helped maybe adjust our view on what was happening with why performance was as it is.
Rick?
Good afternoon. A couple thoughts there. And I think the best way to address that is to kind of give a little synopsis and kind of what our world is like. So at Northwestern Mutual, there's a team of 6 of us analysts. And this is on the wealth management and the advisory channel, who are responsible for the ongoing due diligence and research for $70 billion plus in assets through multiple channels. And the multiple is key because while they're primarily advisory and mostly model portfolios, and then the other segment is like a rep as PM. One thing I'm seeing in the industry, and I think this is a good thing, but there's a demand on our time and resources to provide value in other parts of the firm. It could be, the newest in our case is bringing someone on for the retirement and 401k space. We're involved in other, parts of internal portfolios of the firm, performing, say, attribution or other kind of value adds. But then the challenge for us, of course, is how do we balance our time and resources, and how does it all fit into the bigger picture? So when it comes to investment managers and how we work with, understanding that kind of demand on our time and resources, and really, I think the key question is to understand what our internal process is. So, if it's a first meeting, what would be a successful outcome of that meeting? And if the expectation is to have a quick placement, it's probably not going to happen. But to understand kind of what our flow is and kind of what our work process is, to kind of get to the next step, and then obviously on to a successful outcome. Those are conversations we certainly love to have with managers, so they get a feel for kind of what we're working with. But it's kind of that being part of the team and kind of coming in and giving us something to identify with. So I think we're all skilled in analytics and in understanding and quantifying value add. The challenge, of course, is what are the key takeaways from that meeting? If I'm going to think about it a couple months later, what are the 3 quick bullet points on that manager strategy that are key differentiators? And so I think that it's just that communication flow and understanding the process.
Yeah. And so, Nadia, in thinking about even the ways in which you access managers can be so differentiated as well, and that has an impact then on the universe from which you can draw. So how did you think about sourcing of those investment strategies where you had a need, where you had within the construct of what you were building, where there was a very specific return stream that you're looking for? So how did you go about sourcing those investment strategies at your various positions?
So my experience in alts has pretty much, my whole career has been in alts, but it's been in 3 very different areas. So I started on the operational regulatory side, then for a long time I was on the investment manager research side, and then I was on the sales side after that. So I know how the sausage is made. I know how it's sold. I know everything about it. And the interesting thing, and I've worked in all of the retail channels as well. And I think the really interesting thing about the bank channel, which is what I spent a lot of time on at Goldman, is that it's very model-oriented. And most of the clients that I worked with actually had no kind of basis for including alternatives in their models. So I think the resource help is the best way to get your foot in the door, and the kind of resources that I feel that these clients need are kind of the portfolio construction, capital market assumption, benchmarking kind of resources, because they want to know how do these strategies work as an asset class, and then how do they work with the rest of the portfolio, and then what is the short-term outlook for these strategies given your current market outlook, and what is the long-term outlook for these strategies. So I think the resource approach is the best way to get into the door. And then what Eric was talking about, there's so many different categories of these funds, especially the newer strategies, and actually the category doesn't really tell you much about the strategy, because if you look deep down into a strategy, into a category, there could be 100 funds and 100 different ways of doing these strategies. So you actually have to help them grasp what is the whole landscape that they're looking at, and maybe some characteristics that they should drill down on to help them narrow down their search. And then hopefully, when you've approached this sale from a consultative approach, hopefully you have a product that might fit into one of these approaches that they should be looking at.
Fantastic. And then, Tom, you wear so many different hats at Wilmington Trust in terms of how you access and work with managers, which in some cases on the sub-advisory side or separate accounts, you're using mutual funds. right? And that could be a gating factor for you in terms of limiting the way in which you can look at certain managers. So how are you sourcing when you think about those various ways, the various platforms within Wilmington Trust, and are there big differences?
Sure. So we have about 20 billion in AUM on the wealth channel, so high net worth, ultra high net worth. We have an institutional business, and through M&T Securities, Wilmington Trust is owned by M&T Bank. M&T Securities, we touch the mass affluent audience, so we're touching multiple audiences. We have about 10 research professionals on the manager research team. In terms of sourcing, we use a multitude of databases to do our outbound screening. So we will knock on your door often, and we're really doing our job if we knock on your door early if you're in an asset class like small cap equity. If you're knocking on our door, what we like to have a pre-meeting where we can find out. We don't want to waste your time. We want to really respect your time and work in a very collegial environment with your organization. So active management, as we all know, very difficult business. Alpha is hard to come by. So we want to know, what's the investment anomaly? What's your edge? If you can give us either in a pitch book or via email or via inbound phone call, what the differentiator is, what is your edge, then that could lead to a meeting. So those are the inbound type of activities.
Fantastic. And so Spencer United at UMB.
UMB.
What would you add to the conversation here in terms of thinking about the various platforms and how you're investing in mutual funds and separately managed accounts? And look, each of those platforms has very different end clients, so you have to make sure that they're very appropriate for those clients. So from a sourcing perspective, but also, and if you could speak to the types of managers for each, right? You want to have some level of consistency, I'm sure, across, because as we're surfacing here, everybody's time is quite valuable, and having a number of different mandates and managers that cut across the various platforms can be very time-consuming. It can be very complicated for your teams.
Yeah, so I would say we operate off a pretty narrow list of managers, and we use that narrow list of managers for all of our distribution channels. You referenced SMAs, mutual funds. We tend to try and hire managers and products that can work across all three so that it cuts down on the level of due diligence. I would go back to this issue of time constraint. That's an issue for everyone. So we have a 4-person team. In addition to product research, we do asset allocation, we manage model portfolios, meet with clients. So we try and be as efficient as possible. And one of the ways we do that wasn't touched on, we do quantitative screens, we reach out to our network, but one of the best sources for ideas is previous searches. So as we've cataloged these searches through time, there may have been a manager that just missed out on getting a mandate 4 years ago. There was a bucket of 3, we liked all of them for qualitative reasons, one probably won out over another. You might circle back to that several years down the road, and that's kind of usually our starting point for identifying new managers in these asset classes is people we've met with previously, people who made a short list, and then we've maintained contact with over the years.
Spencer, I think that's a great point, and I'm sure for all of us to hear encouraging. So even after that initial due diligence, you go through the efforts of underwriting a new manager or strategy, even if it may not be appropriate at that individual point in time, you have a memory.
Yep.
And it may come back around to a search that, from a timing perspective, maybe at that initial conversation, it wasn't the right time, wasn't the right fit. Right, because again, going back to this point of what we continue to discuss here, and you hear certainly a lot of consistency in the questions that we're raising here. It is about that time allocation, managing your time effectively. So Nadia, I might start with you on this one. Absent of an active search, and I know everybody in here doesn't want to hear this, but you can't have an infinite amount of active searches in every asset class before every meeting. But how are you determining, and what factors are you looking at, absent of that search, of when to take a manager meeting?
So I think most people are open to manager meetings as long as they have time. But it's got to be something that you put forth that's different than other people. And a lot of it has to do with, can you find a problem that a research person has that you might be able to solve, either through your research or through one of your products? And I think that, and we've heard some of this echoing on the other panels, having a solution to a problem and then how you fit in, I think is the best use of the research person's time. And the problem might be, could be different things, right? It could be that they want an alts manager, but they haven't figured out how to get around to doing this alts thing at all. So maybe you have a one-stop shop solution for them that kind of solves all of their portfolio management problems. It could be that they're allocated to an asset class that's actually been performing poorly, like managed futures. And maybe your managed futures fund has done different than other people's managed futures funds because it's constructed differently. And so you think that your managed futures fund would actually have a better outcome than the rest of the category. And it could be that you are actually happy with your managers that you have, but you're at capacity. So a pretty interesting stat about the liquid alternative space is that the top 20 managers have more than 50% of the assets. So a lot of the times when you're going into getting a meeting, you're already competing with somebody in the top 20. So you have to know who those people are, and you have to know how they're performing, and you have to know how you compare versus those managers. And if you're not prepared with that information, the research person is going to see right through you, and you kind of have to lead with that information.
I think that's such a great point. It's knowing your role, knowing your fit within a certain asset class, because in a lot of cases you can't be everything to everybody, and there are a lot of different sub-styles within an asset class. So that's a great point. And for you, Eric, as you think about then the same question in terms of when to know if using that valuable time to meet with a manager is a good use of your day. I mean, everybody knows when you're in Minneapolis, you have to call an U.S. bank, and you're looking to get a meeting with a member of your team, depending on the asset class. So how do you go through that process to determine as whether or not you're going to take that meeting?
I think a handful of factors are going to play into it. One and most importantly is time. One of the things I'd put out there is, understand our workflow process. So quarter end is coming up, right at the end of. Don't call on us the first 2 weeks of July, or even into the middle of July. We're very busy, kind of dealing with our existing platform, going through doing quarterly reports. But then, in say that August, that second month, third month after quarter end, our schedules tend to open up a little bit more, and we have a little bit more freedom. It's our issue at our team, whether it's kind of the traditional due diligence team that I'm a part of, or my sister team on the alternative side. We want to be good partners to you as we would want you to be for us, right? Because we know at some point in time we're going to be in a search, and we're going to need you to respond quickly for us. So we try to be open to that, given our time constraints. But the other thing is, I think, is if that first meeting that you kind of get to meet, even if it's just one of us on the team, it's always good to kind of spend some time. And what I've seen and been impressed with other folks is having a conversation with us is how we work, how we do searches. Understanding that. But also, I think we're open to it, even if we aren't doing a search at this point in time. We're open to maybe a more general conversation about the firm, about what strategies you like that maybe we should be aware of. Maybe on another thing, one of my colleagues, Peter Brody, always talks about, I want to know the managers who you think are solid, a strong team, but maybe because of the market cycle, they're not performing well. Because a lot of times, those managers are going to come back and perform very strongly in the next cycle and segment. But then the last part on top of that is we like to sometimes have conversations about what are you seeing in the market? What is kind of that street view those folks that are trading every day, what are they seeing? What is that information that you can provide to us? Because as we're changing, and I don't know how many of you folks you understand, U.S. Bank, we have a new CIO, a guy named Eric Friedman, who came from Cap Trust. And so we're very much adjusting and morphing in how we operate as an organization. And I could see going forward, our platform's going to be shrinking. It already has shrunk to some degree. We're going to be pushing more to models. And maybe in some ways we're behind some of the other large banks and regional banks in that. But that's definitely kind of what we see in the future. So in some ways, your job's going to get tougher because there's going to be fewer seats kind of on the bench at U.S. Bank at least. But we don't want to have a lot of turnover. So when we select somebody, we want to be very comfortable that we understand how they're going to perform, when they're going to perform well, and kind of know that there's going to be periods where they're going to underperform, and what those reasons and are. So again, I hope I'm trying to provide a little clarity to you in the sense of, we're open to meetings. It doesn't have to be in a search, but also realize that if we're not actively in a search and you get really very detailed into us in a conversation about a strategy that you really like, unfortunately, I'm probably going to forget what we talked about 3 months later. So in maybe keeping it a higher level and kind of more general.
Yeah, there's certainly a lot to keep in touch with and continue to monitor. And Rick, I thought what Eric had just mentioned there, and being and striving to be a valuable resource, right, and bring a different perspective in terms of the asset class in which you represent. Is that a factor that you look for in terms of making the commitment to a conference call or to a meeting? And what are some of those effective ways that you can demonstrate that you're going to bring insights into whatever's happening out there in the world that could be valuable to you? Yeah,
it's a good question. I think historically we've taken a lot of meetings, and I think we had the bandwidth at that time to do so. But over time, you need to become more efficient and kind of streamline the process. And so it wasn't even a radical formality, but more of a kind of a conversation we would have amongst ourselves to say, look, what's the objective of this? What can we gain from the meeting? And it can come in a number of ways. One, of course, is to be a candidate for the research list or a candidate for models. Those are all very viable reasons. But there's a lot of things going on, knowledge base, that are tremendously worthwhile. So take factors, for example. A big topic, not only utilizing specific factor ETFs, but truly, if you're using an active passive or a truly active portfolio with or with alts, what are your factor exposures and how are you using that in your process, and what can you learn from that? And to have the ability to bring someone that has a core competency in that space in and spend an hour with us is absolutely time well spent. The subject of ESG is one as well. We're not at the point right now where we have dedicated models, but other people do, and there's a kind of a general consensus that the ESG space has some momentum and some legs to it. So you want to be very knowledgeable and have your own database of contacts and who has skill sets there. So if the time comes, you know who to make a call to. So there's a range of value add that can be brought into our offices, and we'll gladly take those meetings. Those are very easy to make, but we kind of go through a kind of pre-screen to say, is there a legitimate outcome? Even on the distribution side, and I think this is true with a lot of firms, but there's been a reduction in, say, the number of dealer agreements or just the number of channels or number of different firms that an advisor will have access to. And if in our world where if we don't think if there's not like a value add from an educational standpoint and we can't honestly utilize the funds, and that's something we would say no to.
Yeah. And so Spencer, when you think about those specific skill sets, you're looking for the perspective of the manager. Is it important for all of us in the room to start to think about then who it is that they're bringing to that conversation? Right? Are you willing to look at and talk to someone that's a specialist on the team? How much do you emphasize having access to the portfolio manager? I mean, everybody here on the panel has always been so respectful about understanding portfolio manager's time should be spent on managing the portfolio, but at the same time, you have to have access. You all sit in a fiduciary role, and having direct access to those making those fiduciary decisions on a portfolio is very important for you to understand the rationale and their key thinking. But from the standpoint of taking the meeting, the initial meeting, how important is it to have a portfolio manager available?
For an initial meeting, no, it's not important. You know, at some point in time, we'll always talk to the portfolio management team. It varies from firm to firm, you know, but there are, I mean, many sales professionals that are extremely knowledgeable about their space. And so for us, you know, those are value-add meetings. Client portfolio managers are fine. On an introductory meeting, not necessary. I mean, it is, as was alluded to earlier, you know, it's about getting to know each other and how we work so that you can best kind of fit into kind of our flow, the meeting schedules that we work on, that sort of thing. But ultimately, you know, there will need to be a portfolio manager involved. I think what we really value, and I encourage my team to take meetings if it's at all relevant to what we do, because it does keep us just in the flow. And we're maybe different than some. I mean, we're in Kansas City, but we like to kind of know what's going on broadly in the market. And so when people come through, we get, you know, intel on peers and competitors in the market. You know, so there's a whole host of things that go with these meetings that aren't necessarily directly related to products. But when it is product oriented, you know, we do need to have a specialist there. We do need to have someone who's very knowledgeable on the space. You know, we've looked at a lot of these spaces for a long time. And then ultimately, we will need to talk to a portfolio manager, and that access is crucial.
Yep. So we started, Tom, to touch on the sourcing. We've now touched on the introductions. Now we're starting to get into process and understanding your process, the duration of that process, what you're looking for when you're evaluating a manager and monitoring that strategy moving forward. So talk to me a little bit about and walk us through your process at Wilmington Trust, because I know you have a very defined process in terms of manager due diligence.
Sure. So we have, on the equity side, we have a process, we call it the Pentagon. We're looking at investment philosophy, investor process, portfolio construction, the firm, and the team. And somewhat differentiated, our process relies very heavily on qualitative factors. In fact, even on the quantitative side, our initial search doesn't have performance numbers in the search, interestingly. So I think our process is quite differentiated. We tend to see a lot of separation of managers right at the philosophy stage, so we spend a lot of time there. What anomaly is the manager exploiting? What's their edge? What do they know that the market doesn't? What do they know, or what do they have in their portfolio, and the valuations versus what's discounted in the market? So we tend to get a lot of separation right in the first portion of our pyramid. And then as it moves down, what's very important are factors like skin in the game, assets of the firm in the firm's strategies, low distraction. We like our managers exceptionally focused on what they're doing and not distracted by doing too many strategies. And you know, fee pressures lead to a lot of agency issues in the business. So our job is to eliminate agency issues, and we see a whole multitude of agency issues. So we kind of have an anti-agency issue process going on as we're sifting through these various parameters.
Yeah. And so, Spencer, I wanted to ask you the question, right? So within that process, and this is really, I hope, an effective way for us to hear directly about how to be efficient within the time that we do have with you, right? So obviously there's a number of different phases that we would go through when thinking about your due diligence process. But when we do have that time with you, we are sitting around a conference table. We have a manager with us, right? We've gotten through that point of introduction. You know, what would be your advice for the group here to be most effective with that use of time in terms of what to cover?
Sure. So I think something that's important to us, and we harp on a lot, is just connecting the dots. So we try and look for, we don't tend to deal with large strategies, large firms. It tends to be boutique, but you tend to run into issues on, piecing together track records, piecing together management teams, accounting for underperformance periods, all those things. I think if that's something that can be addressed up front, that's extremely helpful so that we don't have to dig. Because ultimately we're going to find if there's any dirt somewhere, it doesn't necessarily preclude a strategy from us using it. But we don't like having to spend our time finding it, because we will. So I would say, one, just connecting the dots and being transparent. And if you have a manager there, it was alluded to also, what differentiates your strategy, and spending time there. Hopefully if I'm going into a meeting, or my team is with a portfolio manager, we've read some kind of DDQ or RFP, we've looked at pitch decks, we've gone through websites, and we kind of know how the firms generally piece together who some of the people are. So I think, spending a lot of time at a high level isn't all that helpful. It's really defining what is your edge, what's a differentiator, what do you do that's different, especially as you get into this fewer and fewer slots. We're in that process too. We're downsizing our platform. We'll continue to do so. We've been doing it over the last 24 months, and we'll probably continue to do it over the next 24 months. So, there's fewer and fewer spots to be had, and so the names that are there have to be kind of higher conviction, more differentiated, higher value add.
Yeah, Spencer, I'm so glad you brought that up, right? The connecting of the dots. I think a lot of times we all assume you know who we are. Right? We're making the call to you. You should know who we are and what we do. And it could be a struggle sometimes to get that out of a manager, to connect exactly what it is that they intend to deliver in the form of their strategy, and especially set against varying market environments. So Rick, I'd ask you a similar question, right? Within that meeting, what is it so important for you to hear and to get to it directly within that hour that we may have with you? Maybe you can expand on that point.
Right. So one key point made by a number of commentators, which I think is worth reemphasizing, is the importance of preparing in advance. And so, given that hour time frame, I think it's important to kind of get off the deck a little bit and not go through it on a. You should have read that in advance and really focus on the key drivers of what I think would be the performance and the outcome, and really focusing on the people and the process, and kind of walking through how decisions are made, and actually a real world examples are great, but it kind of gives you the context. But just to get a real feel for how that portfolio is managed, who's making the decisions, or what framework is a joint decision, and to get a real feel of its operation and ongoing management is critical, and not just to go through the presentation itself. I think you got to get past that and to get a real feel for how it's done.
Fantastic. And so, Eric, we've been unpacking this obvious, very, very topical issue around active and passive, and certainly that has only accelerated here over the last 5 years. Thinking about the role of active management at U.S. Bank, how are you thinking about and how do you pair that together? There's a varying number of alternative beta and cheap beta to access. It's very commoditized. Clearly, to underwrite an active strategy takes a lot more time and effort. So how do you think about now the overall coexistence of active and passive instruments?
Well, I guess in the sense that we do believe they should and do coexist. We've been building out our passive platform via exchange traded products and funds, but we're not giving up on active by any stretch of the imagination, and we feel that it's an important part. If it comes to model construction, we'll offer flavors from, if a client or the advisor is looking for something that's completely passive, right? We can give them that option. To the other end of the spectrum, that's 100% active. But I think what we're finding is most folks at U.S. Bank want a mix of that, right? They want to be able to use the very low cost passive strategies in places where we see it's tough to squeeze out alpha, right? And then supplement that into other areas. So I think we're seeing that, right? There are very good large cap active managers. So I don't think it that, you know, U.S. domestic large cap we're going to only be passive. No, I think there's going to be a combination there, and what that mix is could change over time depending on kind of where we see the market and the opportunity for active managers to outperform. And we're starting to put a lot of data internally, analytics, and kind of looking at that is what kind of market environment do we feel that it's more of just a beta market and you want to hold on and ride that market momentum and be more passive in that space, or where do we want to be more active? And there are going to be certain, you know, like municipal bonds, which I cover, will always be looking for a more and more active manager, or, you know, kind of smaller nicher asset classes where we want to be more, it's important for us to be more active. I think, well, you know, and recently we've rolled out an investment opportunity to the field in the midstream energy space. And we had a discussion internally is like, well, should we make an ETF or an ETN as an option? And we really looked at it and the opportunity, given the dislocation and the opportunity there, we thought it was much more important to have an active manager. So we didn't add a passive option to fit this opportunity. We only went active. So there's maybe a good example.
Oh yeah, those passive trends clearly have had an impact on different asset classes at different magnitudes for sure. And Nadia, you know, arguably you'd say maybe alternatives have been less cannibalized so far in terms of indexing. But they certainly have not been immune from the fee pressures that have been permeating the industry for sure. But how do you think about, and from our conversation, it looked to be as though there are some trends out there that are starting to percolate in terms of more efficient ways to maybe hedge a portfolio. So maybe speak to that as we continue this active passive debate.
So I think this is really interesting how ETFs a la 2004 you know, started to slowly take over the active long-only equity space. And then we got into the second phase of passive was the smart beta, which is just kind of passive with a few factor twists. And then now we've morphed into an alternatives, that kind of smart beta factor investing, but on the long short side. And this can be called alternative beta, can be called alternative risk premia, but it's basically rules-based hedge fund strategies. And that appeals to investors because rules-based is what, especially this market, the insurance bank market, they want to be able to have something that's rules-based, that has a benchmark that they can put into their models, that they can trace back and see how it does in different types of environments. But it's also fee conscious. The types of funds that have struggled in the alternative space have been the funds that are kind of in the middle in terms of the active, passive, and kind of in the middle in terms of the fee spectrum. And what has, so like the funds of funds kind of model is totally out of the window, the 2% fund of funds kind of model. And what has stuck is on the low fee, rules-based side, the alternative premia, which is basically like a 1% fee kind of strategy. And on the completely on the opposite side of the spectrum are the private market retail products. So bringing private equity, private real estate, and private debt into retail structures. And guess what? Investors are actually willing to pay up for those strategies. So active has moved to an area where active is actually working at this point, and people are actually willing to pay for, a lot of studies say, about a 3% increase above public markets for your return, and maybe for on the credit side, at least a 2 to 3% increase in yield over the high yield market on the credit side to lock up your capital for a period of time. And people are willing to pay 2% and sometimes a performance fee depending on the structure for those kinds of products. But on the hedge fund strategies, which have become increasingly commoditized, the more liquid long-short strategies, what is working there are the factor-based strategies that are rules-based, and people like these allocators can make heads or tails of what is going on in these strategies in different environments, and they're reasonably priced. They're still more expensive than your typical passive fund and even your smart beta fund, but they're very reasonably priced at 1% or less. And so I think that these are the trends that alternatives have moved into. And then there's kind of a third space, and that third space is the multi-asset class space. So we've been seeing a lot of asset managers and other folks, consultants and stuff like that, put together multi-asset class portfolios where they're kind of piecing together these passive strategies. So they're passive building blocks, but they're actively put together. And the problem that they're addressing in that space is people don't know what to make heads or tails of the market right now. They don't know. They want to have somebody that's doing some kind of tactical asset allocation, but they don't have time to do it themselves. So if they can put a piece of their portfolio or a piece of their model that's going to be tactical, and it's going to be tactical in the different equity asset classes, it's going to be tactical in the different fixed income asset classes, and it's even tactical in alternatives, then that works. That solves a big problem that these allocators are having. So that's how passive has moved into alternatives, and that's how the rest of the alternatives have shifted because of that.
That's great. And Tom, I didn't want to hear from you. With all your great experience that you've had over the years, are your expectations now for active managers different than, say, they were 10 years ago? And thinking about the specialization and how you would look for certain characteristics from that active manager. I know it's going to probably vary by different asset classes, but just curious if you've seen how you've seen that progress to now where you're looking at active managers a little bit differently.
Yeah, good segue from the prior discussion. So certainly passive has a role. March 9th, 2009, oxygen getting supplied to the left for dead. I do want some beta, cheap beta, when the market's recovering. But a bad example of beta today is international bonds or the global aggregate ex-US, where you have a yield to worst sub 1%, yet a duration of approaching 8. So sometimes asset classes are expensive, or indexes themselves don't make sense. So good news for everyone in the room on the active front. There is a role for active at different points in time. How has it changed? A number of people have mentioned smart beta, and I think what's probably changed from many gatekeepers is paying for some factor that's embedded in a portfolio is probably very yesterday. So for active managers to be cognizant of where they have factor tilts. Now there is dispute in the whole factor industry because what constitutes value will be where the next round of fighting is going to take place because not everyone's definition of value is the same. You have some large caps with negative book values today, so there'll be dispute around what exactly is value for one factor as an example. But moving forward, you have to deliver your alpha, prove it's idiosyncratic, and it's okay to have some factor exposure, but going forward, don't expect to get paid for it. So that's one of the things I would comment.
It's very helpful, and I'm being told that we're bumping up here against time, and I did want to leave at least a few minutes here for us to field questions from our audience. Do we have any questions? All right, looks like we touched on everything. So thank you so much to our panel here, all the great insights. Hopefully you found it helpful, and we'll continue with the agenda.